When advisors really start thinking about smart beta, I think the term itself can be a little off-putting, but we find most advisors who are successful using smart beta think clients first. What am I really trying to accomplish for my client? Let me take a step back, from their risk and investment profile. Then let me think about the macro investment conditions. And as we said, don't fight the Fed. So if the Fed, and we're looking at an environment where, again, risk and return dispersion is going to increase, we're going to see rising rates, the potential for higher volatility. Well, what does that mean for my client's goals and objectives? Therefore, themes like lower volatility. I've had a really good run in my risky assets, particularly in equities, over the last 3 to 4 years. How can I still protect my my purchasing power from future inflation? How can I still be exposed to equities, perhaps, but how can I do it in a lower risk way than traditional market cap? We see many retirees, baby booming clients, boomer clients who need income. We see, again, with the lower interest rates, looking at dividend strategies. How can I get the higher yielding equities? But wait a minute, I'm a little worried again that volatility may increase, and therefore again, we apply the same concept. Let's provide a low volatility screen to high dividend yielding ETFs, our product is SPHD in that case. So if you really think different ways to do it. And then I think the key for good long-term strategic portfolios, continuing to add assets and factors that continue to diversify the portfolio, again, in line with those particular risk goals. If you think about the terminology, you can have endless debates about smart beta, strategic beta, alternative beta, and I really think that if you take smart beta, which seems to be the most common terminology, and you break it down, ultimately it's a series of factors. If you think about, in and of itself, market cap weighted is a single factor. It's the market portfolio that William Sharpe and many other academics have defined over time. So you start with that one very blunt market factor, but now you're starting to add additional factors again. And what's so important is whether it's momentum, low volatility, value, smaller cap, all of these things, what they do is it effectively give you a premium, a risk premium, in good times that help you increase diversification in bad. So the idea is to, again, come back to those client needs, what the client's trying to accomplish, and for those financial advisors who, again, can look at the toolkit, maybe tactically use a few individual factors, or perhaps, as increasingly we're seeing, take an alternative weighted index and actually move it to the core part of the portfolio to really, again, help meet those risk return goals. So like I said, you can call it many things, but ultimately I think for financial advisors and for clients, it's really looking at what are you trying to accomplish? And let's look at that toolkit as it broadens. How can I get back to your basic goals and objectives of long-term wealth creation?